This video is going to look at how to combine moving averages to trade breakouts. Hello, I'm Peter Martin with Trading 212. Now, in some of our earlier videos, we looked at an introduction to breakout strategies, and in this, the idea is that you are identifying levels of support and resistance in the market that the market is stuck between, and then eventually when the market does break out of these levels, how it can sometimes lead to the formation of a new trend. So a breakout strategy is effectively a form of trend following. Now, the difference with what we're going to look at in this video is rather trying to subjectively identify where the support and resistance is and then trade once it breaks out from that. We're going to use moving averages as a kind of systematic method of giving you a trading signal that tells you that the market has broken out and that possibly is forming a new trend. So in our charts, we're going to look at a number of different ways in which we can combine moving averages in order to do this, and we'll look at some examples of how that can successfully help you follow a trend, but we'll also look at those difficult times when the new trend doesn't form and how difficult that is, and how volatility can also throw us a few curveballs. So let's take a look at some charts now. So we'll begin with a chart here of Euro versus US dollar. It's a daily chart, and we said in the preamble that this is going to be a trend following strategy. It tends to be a fairly long-term strategy, so we are looking at daily charts. You'd probably be looking at holding positions somewhere in the order of weeks, maybe into months if it turns into a long trend. So I'm going to add two moving averages. One is going to be a quicker one and one is going to be a slower one, and really we're looking for a cross of the shorter one over the longer one, and that will be our signal to trade. So first of all, I'll add on the longer one. So I'm going to go to indicators, trend, and this I'm going to use a simple moving average, and the number that I'm going to use is a 150-day moving average. I'm going to make it a little bit thicker than normal just so it's easier for me to work out which is the longer one. So there is our slow moving average, the 150-day moving average, and then we'll add on the quicker one. So this time I'm going to use an exponential moving average. I want this to be a more responsive one, so I'm going to make this a 50-day exponential moving average. I'm going to make the color green. That just tells me this is my action line. Leave it a thickness of 1, and there we go. Now, the reason I'm using exponential moving average is just a personal preference. You could use a simple moving average if you want. You'll get similar-ish results. The exponential moving average, as that's our responsive one, it weights the average more towards recent prices, so that it means it's slightly more responsive to price. It just means it moves a little bit quicker. Or a little bit more responsive to more recent price moves. It just slightly changes subtly the character of that line. So we can see we've got this cross here. So this would be a sell signal. Obviously we've got this downward move in euro dollar, and moves all the way down to a low here, but we have bounced back there, and we'd have had a sell signal all the way back there. So we would have been in on that move. Obviously you can see that there is a lag before we start following, and it's quite substantial. Unfortunately, there isn't really a way around that. Moving averages are by their very nature fundamentally a lagging indicator. They're always going to tell you afterwards, so you're always pretty much going to miss out on the first part of a move. How much you miss out on depends on really the settings that you go for. You could get this cross to come earlier if you move your shorter moving average to be a shorter time frame. It's really a trade-off, because the more responsive you make that shorter one, the more likely you are to get faked out by moves that aren't breakouts, and you might find that you even get closed out earlier in the long-term trends. If we zoom out here, we can see that we also got a buy signal all the way back here. So really this strategy would have worked really well for euro dollar. It would have given us a long position all the way back here. So we would have bought in probably the next day here around about 109, and then we'd have held the position all the way up here until we went short here. So one thing that you should note with this strategy in its most basic form, if we're just using two moving averages, is you're always in the market, so that you buy in here, you keep going until you get your sell signal, so then we exit and then we take a short position as well and we go short the market. We can see that worked very well for euro dollar. Obviously it's not going to work always. No strategy works all the time, and in fact there will be plenty of times where this doesn't work. So let's move on to look at gold next. So I've already got the same lines marked on this gold chart, and we can see that we would have a short position at the moment. We'd have gone short here, and we'd still have the position right now with the gold in this downtrend. If we look back here, we would have got a sell signal here. That was pretty much a bad signal. We would have gone short and the market would have risen, and then we would have gone long here. Now if you look at where you'd have gone long, although it's correct that we did get this uptrend here, it's on this candle, so you'd be trading the next day and you'd be probably opening around here at 1303. Keep going, keep going, keep going. But when you come out, the market would have been all the way down here, somewhere around about 1297. You'd have made a loss there. So even though it got this move correctly, coming out, you're holding on for so long, it doesn't respond so quickly that it gets you out at the highs. Now there are options. If you don't like the idea of always being in, you can actually take a time-based exit, which would be that you take this signal and you give it a certain number of days that you hold on to the position, maybe 20 days, 30 days, 40 days, whatever you feel works best by looking at charts and analyzing it. The trouble with that is that you're going to miss out on the really big moves. On something like gold, if you chose 20 days, we'd have gone short here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. You'd be out here. You'd made a profit, but you'd have missed out on all of this. So obviously if you go 30 or 40 days, you're going to get more of that profit. Be careful though of curve fitting, of trying to fix it too much to what has happened in the past, because what happened in the past may be a good guide as to what's likely in the future, but it doesn't definitely predict what's going to happen in the future. If we go to oil, let's have a look here. Once again, I have the same lines marked on here. If I zoom out, we can see we'd have got this buy signal here. We'd be long the market all the way up, and we'd still be long the market. It is closing back towards, maybe sometime in the future we'll get a closing signal out there, but you'd still be long oil, having got in probably on this candle up about $52, and you'd still hold your position. You'd have held it all the way up to where we are now, which is currently $65. Once again though, you'd have missed off, part of the problem with following the trend is that trend following does create this horrible thing of when the trend breaks down, you give back some of your profit. And then we can mitigate that to a degree by having a time-based exit. But once again, even if you'd taken a very long period of 50 days or 80 days or something like that, you'd have been out a lot earlier in comparison to the actual duration of the trend. So you'd miss out on some of the profit by doing it that method. Let's move on to the Footsie 100 here, and this is going to show us how a scenario when this method doesn't work, or you'd have got yourself in a lot of trouble. You can see that you get, on this example, we've got quite a lot of signals, and they pretty much would be timed horribly because the market's been whipping around, and the delayed nature of the moving average, you'd have been getting in and out at the wrong time. So yes, here's a big dip in the market and we do get a sell signal, but because of the lagging nature of these moving averages, we are getting in all the way down here. We've missed the move. Yes, the market comes down further, but when do we get our signal to exit? It's all the way up here when the market's bounced back. So that whip, it's really out of sync with what our signals are being given by our indicator. We'd have bought in here, and that's all the way up here. FTSE is currently much lower, so we'd be sitting on a losing position there. We'd need this trend to build back up again for us to start getting back in the money, and we can see that we'd have had lots of false signals there. So, and this unfortunately is very much a characteristic of this trading method. If the market isn't trending, you are going to get false signals, and once again we can mitigate that to a degree by tweaking our values of our indicators, our settings, to try and you can make, if you go with longer values for both the long moving average and the shorter one, you'll get fewer signals, but the longer you do it, once again, the bigger the lag will be. So the reason I chose the 50-day moving out EMA as my shorter one is that was a bit more responsive, and actually if we make that longer, we're going to get this sell signal even further after this dip has occurred, so it could even be worse. So then finally, let's move on to the Nikkei here, the Japan 225. Now what I have here are three moving averages. I've got a 50-day EMA again, this is my green line, and then I've got 100-day simple moving average, and these once again operate as the signals, but then I've got this third one which is a filter. Now this is a 250-day simple moving average. Just to zoom in here, now we can see that what we're supposed to do with this one is you're not always in the market, and the filter says that you can only trade if both of these are the right side of the filter, so that if they're above you're allowed to buy, if they're below you're allowed to sell, but otherwise you can't. So here we get a sell signal from the faster moving average crossing under the 100-day moving average, but because we are saying that this is looking bullish with these above the longer moving average, we're not allowed to sell. When we get this buy signal here, we are above, we are allowed to buy, so we'd go long the market here, and we'd still be long the Nikkei here now, but they're almost on the verge of crossing, which would be a closing signal for us to get out of the market. Or of course you could implement your time-based exit if you wanted. So that's using three moving averages, using the really long one as a filter to filter out some of these signals, so that we're not always just trading when we get across. We can only follow the signals that are in the direction of the overarching trend, as indicated by these two lines being above or below. Above for a bullish, for an upward trend or a bullish phase, or below for a bearish phase. So those are a few examples to illustrate the ways in which you can combine moving averages to help you tackle trading breakouts. Now, of course, this strategy isn't going to be for everyone. If you're not a trend following type trader, for example, this won't be for you. But if you think it's something that might appeal to you, it's always a good idea to try it out first in a demo account and see how it works for you. The settings that I used are just examples. You might want to change those values up and see if you can tweak them to come up with more optimal values that suit what you're trying to achieve. Now, I mentioned we've got some other videos introducing breakout trading strategies. They're a good place to start. The best way to access those is to click the subscribe button and subscribe to our YouTube channel. As well as doing educational videos on trading, we also have material looking at analysing popular markets like gold and oil and the euro versus the US dollar. And if you've got any feedback about this video, or if you want to suggest a topic for us to cover in the future, why not send us a message in the comments section. We do read through every comment that comes in to us. And we do put out new videos on a regular basis. So the best way to find out about when those have come out is to click on the alarm bell icon, and you'll get a notification the next time we upload a video to YouTube. But that's all from me, Peter Martin, and Trading 212. Thanks for watching. Good luck with your trading, and I'll see you next time. Goodbye.